Hey everybody, welcome back to H Invests. Today we're talking about a very unique investment opportunity that has garnered a lot of attention in the investment space, and that is Warner Brothers Discovery. I'm going to give you my take on it, exactly what's happened, and whether I think this is a good opportunity right now. I hope you guys enjoyed the video. So Warner Brothers Discovery is a relatively new company. Effectively what happened is after buying Warner Brothers in 2018, AT&T decided to spin off the assets and effectively sell them to Discovery. Discovery and Warner Brothers merged together to create a new company, Warner Brothers Discovery, that still trades under the Warner Brothers framework, but the two will now be effectively operating as one entity. Why has this gathered a lot of attention? Well, you can see the share price of solely Discovery pre-merger. And since the merger, which was in April of 2022, the shares of Warner Brothers Discovery as a new company have actually fallen by over 50%. And it says $13 here, but since putting this research together, the shares have now fallen to around $11. Crazy stuff, I know, right? Here you can see a bit more of a zoomed in picture of exactly what's gone on. This is a company that's taking on Warner Brothers, adding a lot of potential value, but the shares have absolutely collapsed. And this has led a lot of people to believe, could there be an opportunity here? You can see as well that in financial year 2021, Discovery, again operating as its own, as a separate company, reported 12.2 billion in revenue. But for December 22, they are forecasted to generate 45 billion in revenue. Basically what this means is Warner Brothers is 3 times the revenue of Discovery. So when they merge together, their revenue is forecasted to nearly 4x. And you can see that pattern continuing. All the analysts are consistent with that going forward. Something else to consider is the insiders are continuing to buy. This is a very, very positive sign. We haven't seen many cluster buys yet, but we did see another buy from the international president in August. This is always a good sign when you can see people that have control of the company, a significant interest in the company doing well, buying up more shares. And also, considering this has been such a new company, you've seen in the 13F filings a lot of notable investors buy Warner Brothers Discovery, some of which has quite large positions of their portfolio. So Mason Hawkins, nearly 5%, Seth Klarman, very well regarded, 4%, the Hillman Value Fund is added, 6 of these 8 have added, David Einhorn keeping his 1.72% position, and there has been one slight reduction, but this is not a significant part of Lee Ainsley's portfolio. Michael Burry also held a huge position in Warner Brothers Discovery, 11% of his total equity portfolio. He's since sold off all of his equity positions, so he did sell off Warner Brothers Discovery. Due to the company specifically, it was more just a macro thesis. The equity market was absolutely going to crash, so he sold off everything at once. But it's clear that Michael Burry was also interested in Warner Brothers Discovery as an investment. So you might be thinking, what is the catch? You've got a merger. Warner Brothers is a huge company, added on to Discovery, nearly forecasted to quadruple their revenue, but the share price has collapsed since the two companies merged together. Well, in this video, we're going to talk about 3 catches or negatives or concerns that the market might have, and I'm going to try and deal with those concerns one by one to evaluate whether Warner Brothers Discovery could make a good investment opportunity. So you've got AT&T, yes, they spun off a load of assets with Warner Brothers, but they also spun off a load of debt. AT&T was in a ridiculous amount of debt, I think over 100 billion before the spin-off, and they decided to leverage Discovery a bit because Discovery didn't have a ridiculous amount of debt before the merger. So now Warner Brothers Discovery's total borrowing is around 53 billion. You can see the borrowing forecasted to skyrocket here when they finish up for 2022. And that's significant because the market cap of the total merger now that has crashed is only 27 billion. So you've actually got the total value of the debt being double what the market perceives the total value of the company to be, which is not a good sign. Okay, so also it's the business operations of Warner Brothers Discovery. You've got networks, which is basically conventional television, cable, pay subscription, television channels and advertising, that sort of stuff, it still makes up over 50% of the revenue. And there's also streaming. So this is 21% of Warner Brothers Discovery's revenue. They've got home box office, and they've also got Discovery Plus. They're planning to merge the two next year, actually. So that makes up 21% of the revenue. And of course, yeah, it's a growing business. It's kind of leading the transition away from conventional TV. However, the market is incredibly saturated. We will look at that a bit later. You've got so many players, and you've got to think, are Warner Brothers Discovery just a bit too late to the table here? Thirdly, AT&T shareholders are creating a lot of selling pressure. So this is something that obviously we've seen huge share price decline, and AT&T, they obtained 71% of all of the Warner Brothers Discovery shares through their ownership of Warner Media. So why did that happen? Because Warner Brothers, it made up such a big part of the revenue of Warner Brothers Discovery, and AT&T previously owned the company, it was only right that the shareholders actually took on most of those shares for Warner Brothers Discovery. So that's something we're going to talk about as well, is why are the AT&T shareholders so desperate to sell? Because clearly some of them are sold. If the company's down 50% since the merger, or more than 50% actually, but they previously owned 71% of Warner Brothers Discovery shares when the merger happened. Okay, so before we address those concerns, let's just very quickly go through the business, and then we will go through all of those one by one. So, as I said, networks are over 50%. Warner Brothers, they own dozens and dozens of networks. Discovery obviously have their own as well. Some of the key ones, CNN, Discovery, TBS, Food Network as well, and these networks make money through their affiliate fees. So all of the cable providers, they pay television channels affiliate fees in order to drive traffic and therefore drive subscriptions to cable TV. And also the television channels get huge advertising revenue for companies that want to get ads in front of, you know, people's faces watching the TV. So that's basically 50% of their business. Another 26% is the studios. So this includes all of the production of new movies that sell in cinemas, that then sell to people that purchase them afterwards. And also they have their own cinema chain. So Warner Brothers Discovery, they have their own kind of cinema chain where they can showcase movies, and that will bring in revenue, which is included in the studio segment. And they've also got huge intellectual property licensing. So this is just one example. Warner Brothers own Harry Potter, and anytime anybody wants to make something that's Harry Potter related or profit under the Harry Potter brand, whether it's Lego or the Harry Potter theme park, or whether it's a wand, then receive a section of that profit under royalties because they own the intellectual property for these franchises. And lastly, you've got the streaming, pretty self-explanatory, home box office and Discovery. And you have people basically pay subscription fees in order to access a whole basket of content. So that's that. Let's go through firstly the debt issue regarding Warner Brothers Discovery. So net borrowing, 53 billion. Is this debt sustainable? So it's quite scary. Market cap's down at 27 billion. Debt is double that. The good news is Warner Brothers Discovery, they do have decent free cash flow forecasts. So they're forecasting 3 billion in free cash flow for 2022, but then a jump to 6 billion in 2023, and then another jump to 8 billion in 2024. Now you can see that the average analyst agrees with that under this free cash flow line. If anything, they're being a little bit more generous, just shy of 3 billion in 2022, then over 6, and then over 8, you know, as we go into 23 and 24. So we do have a fair bit of free cash flow to deal with this 53 billion in debt. Warner Brothers are very, very transparent about their debt, and I think they have to be, because if they weren't, any investor would just be too worried and they wouldn't want to touch this with a barge pole. So what you can see is here we've got a breakdown of the average debt maturity by year. So you can see that in less than 3 years, 29% of the debt will be matured. 29% of 53 billion is 15.37 billion, which they've got to pay down in the next 3 years. Now, if we look at their free cash flow, and if we also add that up to what they've got in cash and cash equivalents, all of those forecasts, they give us about 20 billion. So they've got 15 billion to pay down, 20 billion in free cash flow plus cash and cash equivalents. So they basically have to use just over 3/4 or 77% of that money in cash flow to be used to pay down their debt, which is a high figure, but it's showing that at least in the next 3 years they can do it. And then for 3 to 5 years, they've only got 10% to worry about, and then another 20% from 5 to 10 years. So these next 3 years are going to be the hardest. You know, their free cash flow forecasts are projected to go up long term. If they can survive getting rid of this 15 billion in maturing debt, which I think they can, it's going to be quite tight, but if they can get that free cash flow and use it to pay down the debt, then they're going to be in much better shape financially. So yeah, of course, one of the things about looking at it that way is that, yeah, it's 15 billion in less than 3 years. So let's just take another example and look at next year. How much have they got maturing next year? It looks quite good for next year because they've already got the 2.6 billion in cash and cash equivalents. Then they're forecasted the 3 billion in 2022. So that makes just over 5.5 billion. And then if you add up all of these notes that are due kind of before the end of financial year 23, then that's only 1.35 billion they've got to pay back. So again, it looks sustainable. Another concern, and the big concern about debt really is, okay, you've got massively rising interest rates everywhere. Any company that's leveraged is going to have to pay a ridiculous amount of interest. And if they borrow that thinking, okay, the base rate is going to be, you know, 0.5%, and our interest rate is going to be the base rate plus 1. That's going to be a 1.5% interest rate, but all of a sudden inflation problems happen, they skyrocket, the interest rates also skyrocket to try and curb the inflation, and then, yeah, your interest rate goes up. So, but the good news about Warner Brothers Discovery is that 87% of that 53 billion in debt is fixed, which is really good. Fixed interest rate, also low interest rate. Look at these interest rates. So this one's 9, this one's 1, 4, 2, 3. You know, their weighted average cost of debt, I think it might even be on here. Yeah, average cost of debt, 4.3%. It's not a particularly high interest rate at all. You've got 7 billion in total if you go through all of their debt liabilities that's variable. And all of that matures within the next 3 years as well. So I'm sure they're going to prioritize paying this down first. But it's not a case of them having, you know, tens and tens of billions of long-term variable debt that they can't pay down at all. Their debt situation is high, but it's good that they're free cash flow positive. It's good that they're going to be able to generate free cash flow in order to pay down the debt. And when they look a bit less leveraged, the market is going to look at them much more favorably. So the debt issue, yes, it's going to be close, but I'm happy that they are going to be able to afford to pay their debt down over the next few years. Concern number 2, business threats. So I already discussed the studio segment, huge amounts of intellectual property. That helps generate very, very high margins because once you own the franchise, there's very little kind of capital input you need to put. You know, you have a lot of third party, as I mentioned, Lego, or whether it's Universal that builds big Harry Potter theme parks. All you do is you own the intellectual property and you can generate royalties off that. Easy peasy. Same way that you own the shows. You know, if you have another channel that you don't own that wants to show one of your shows, then you get, you know, the intellectual property rights for showing those shows as well. So yeah, there's a lot of passive long-term income to be made through owning these franchises. And it's not just these. Warner Brothers have a very diverse portfolio of franchises. But the network business, so yes, it's a legacy business. It is going to serve as a cash cow for the next few years, but I think the market often underestimates how quickly we see the decline in conventional TV viewership. There's still over 60% of US households that pay for cable, and what Warner Brothers are going to try and do, now that they're this big vertically integrated company with Discovery, is they can expand their own streaming platforms. They were doing this while they were under AT&T's guidance as well, but now they're a separate entity and merged. They can use this massive amount of integration to then move customers away from the old conventional cable to their streaming service. Warner Brothers also own a number of sports assets, which is good because it keeps people on cable for a longer period of time because people like to watch sports live and this sort of stuff. And yes, I'm not denying that cable is in kind of long-term decline. It's just a lot of the time the market overestimates these declining trends, sells off these stocks like there's no tomorrow, and then all of a sudden yeah, they actually realize there is still a lot of value to extract in these conventional industries. Now, the streaming business is good. We've got like a lot of growth here. So from Q2 2021 to Q2 2022, we saw a 25% year-over-year increase in subscribers. I think that this will slow down. I think that we see huge pressure on consumers all around the world. And these month after month non-essential subscriptions, particularly if people are subscribed to multiple different companies, it is going to slow massively. I think that Warner Brothers, they're going to get significantly more exposure to markets outside of the US. They plan to expand to about 70 countries in the next couple of years, and they will get a lot of new eyeballs, but I don't expect this sort of growth to be sustainable. Some good news is they do have the third highest basket of content, movies and shows after Netflix and Amazon Prime. So they have a lot more content in their library than Disney. This chart is actually about a year old, but it just kind of shows you where we are roughly in terms of the amounts of subscribers. So Amazon Prime and Netflix are kind of the top players with Disney, but Disney's grown a lot since this chart was made actually. And now we've got HBO and Discovery combined, so that kind of makes them at least the fourth largest platform in the US. You do have Tencent and Alibaba that are larger in China. But yeah, Warner Brothers Discovery's collective platforms, as I said, they're planning to merge HBO and Discovery into one big streaming platform. They are kind of the fourth largest in the Western world. And also, the services are very, very cheap. If they combine HBO and Discovery Plus, there might be some wiggle room for them to then raise prices because they are showcasing this huge content of library when combining the two different platforms. However, they have been acting some content recently. I was doing some research and following people that were heavily into various shows that Warner Brothers Discovery made. And they are cutting back on some of their content in the short term just so they can save a bit of money in order to pay down the debt and pivot their company. If they do this too much, obviously it will become a concern because then they have no leverage to grow a platform with fewer content on it. So that is something to bear in mind. I will say though that whilst I'm talking about all of these different things, the actual key thesis in the business is now the valuation. As I said, we are looking at a company, Discovery, that has basically acquired a ridiculous amount of assets, a ridiculous amount of TV networks, a ridiculous amount of intellectual property and shows, a huge scale of production and franchise, and yeah, also a massive additional streaming platform that's gone under one company, and the entire market cap of the company has fallen massively, and there's a valuation opportunity. We've just got to wait for some of these negative concerns or headwinds to subside, and it could be a good deal. Let me just show you an example of that. So firstly, as I said, the EBITDA for next year is forecasted to be 9 billion, over 9 billion. And if you look at the market cap of 27, it's trading at 3 times EBITDA. And if we just go back to these forecasts, you can see the EBITDA is projected to continue to increase up to 13 billion in 2024. There's a lot of depreciation charge coming off this year, which is why EBITDA is negative. But even still, you know, EBIT of 3.3 billion in 2024 and free cash flow, which is the actual cash coming into the business, up to 8 billion. So by 2024, that 8 billion in free cash flow is only going to be 3.5. The price is only going to be 3.5 times the free cash flow if it stays at the market cap of 27.4 billion, which is really insane. I've made a free cash flow estimate here. This is current free cash flow and growth coming in, so 3 billion, 6 billion, 8 billion. And then I decided to put in a bit of a slowdown. Eventually, as the free cash flow catches up to turnover, I think the margins will max out at about 17%. I don't really see free cash flow margins getting any higher than that. And then long-term growth, trailing it down to 2%. It grows 2% long-term. Let's discount it at 10% because it's a new company. It has its risks. It has its cyclicality. We get a share price of $23. We actually get a market cap of over 100 billion, but of course we owe nearly 48 billion to the people that we borrowed from. That's gone down from the 53 billion because since Q2, Warner Brothers Discovery, they have started to pay down the debt, and there is cash included in that. So net borrowing is obviously the total debt minus the total cash. So then we still get an equity value of 55 billion, nearly 56 billion, on a market cap of 27.4 billion, which is obviously just over 100% upside. So this model is showing the fair value of the company to be $23 per share. We're currently at 11. So I think there's considerable upside there. And at 3 times EBITDA for a company of this scale, with this many assets, with a legacy business, with a wide moat, and significant streaming customers, we're talking nearly 100 million in streaming customers and 8 billion in free cash flow by 2024, which analysts agree with. I just think that this company represents a really good risk reward profile, and I think that the market has been very quick to sell it off. And there's a good reason for that. Reason number 3, which I'm going to talk about now, is that there could be some selling off that is not actually related to the fundamentals of this company at all. I mean, why would a company of this scale, with these assets, with this sort of diversification and vertical integration, be trading at a forward enterprise value to EBITDA of 3? Well, as I mentioned earlier in the video, when the Warner Brothers was spun off from AT&T and merged together, obviously the AT&T shareholders had a right to a large proportion of that company, because Warner Brothers was much larger than Discovery. When they merged together, AT&T shareholders, they obviously lost a big chunk of that business, but they still legally owned it. So they were entitled to 71% of the Warner Brothers Discovery shares as part of the merger. Now, what's clearly happened here is you had Warner Brothers being a minority of AT&T, but being the majority of Warner Brothers Discovery. So what are AT&T holders going to do? Do you think that many of them really bought AT&T for exposure to Warner Brothers? Maybe it was a part of some people's investment thesis, but it's not the main reason why people held it. If somebody held AT&T shares before 2018, they didn't even have Warner Brothers. They bought Warner Brothers in 2018 as an acquisition. So I think most people that were, bought into AT&T, they probably had some fundamental thesis regarding telecoms, or more importantly, AT&T had a ridiculously high dividend yield and they were buying it for an income investment. And what we've got to remember is Warner Brothers Discovery actually doesn't pay a dividend. So a lot of these shareholders, both large institutions and retail investors, Warner Brothers Discovery gets merged, they immediately control 71% of the company. They say, oh, I'm not interested in this, A, or I don't understand this, B, maybe a bit of both. They just weren't interested and they just sold it off, and that put all of this ridiculous downward pressure on the share price. I don't think it's any coincidence that the steepest sell-off that we saw, sorry, let me just go back a minute, was, right after the merger, the steepest sell-off we saw right from like $23, $24. Coincidentally, that's exactly sort of the range that I think the company's worth right now, all the way down to, $17, $18, right when it started. You can see the increase in volume. I don't think that's any coincidence. I think AT&T shareholders just inherited a load of shares that they didn't really want. That they are in a pretty different industry to what AT&T are in, fundamentally, right? Telecommunications. And also, they are the complete opposite of this kind of like legacy dividend aristocrat that AT&T were. Obviously, AT&T cut their dividends, but their dividend yield was still pretty high, and Warner Brothers Discovery doesn't pay one at all. I also think that because it's a new merger company, the situation does require like high levels of uncertainty, and some funds just won't look at investing in that sort of situation until actually seeing the proof and seeing the financial statements and seeing that Warner Brothers Discovery can perform well as a new integrated company. I think that's what we're going to see. We have got a lot of analyst coverage on Warner Brothers Discovery already. There were a lot looking at revenue estimates, and it was quite reassuring to see the revenue estimate bound was relatively narrow on that 45 billion. However, if you look at the earnings per share estimates, at least the ones that are showing on Seeking Alpha, 2 analysts, 5 analysts, 5 analysts, and of course earnings per share is that critical number. So you've got very few analysts forecasting earnings per share. There is a pretty wide margin between the two, and I think that a lot of institutional investors at least the old large funds that would like AT&T as a diversified part of their portfolio, they're just not suited to this Warner Brothers Discovery investment, particularly after the insane volatility we've seen since April. So that is another thing to bear in mind. I think a lot of investors that got Warner Brothers Discovery shares from AT&T, as I said, 71% of the entire equity, because Warner Brothers was much larger than Discovery, they just sold it off because they weren't interested. The yield, there was no yield. And I think this has caused huge downward pressure on the share price without it being related to at all the fundamental operating business of Warner Brothers Discovery. And I think that that is what creates ultimately this big price disparity. So in conclusion, am I buying Warner Brothers Discovery? Yes, I am. For the catch one that we talked about, I think the debt looks manageable. As I said, I've done my analysis on that. I think that they can pay it down. It's going to be a tough job, but the numbers add up and they can do it. There's a legacy business there which gives them good free cash flow, and there's growth potential in the streaming business. And catch number three, as I talked about, AT&T shareholders selling off what they've just had creates big undervaluation here, and that's not related to the fundamental business operations. I just wanted to mention again, as I did before, this is fundamentally more a valuation thesis than it is a business thesis. I think the business looks good, it's solid. They have a huge amount of assets, intellectual property and scale. But if this business was at $30 a share with, you know, forward EBITs in the double digits, I don't think I'll be looking at it. But with a forward EBITDA of 3, forward free cash flow, what would that be? The forward free cash flow is below 10, but by 2024, 8 billion in free cash flow. And the DCF, you know, it's showing $23 with a 10% discount rate and 2% terminal growth. I think it looks very cheap. I think if Warner Brothers Discovery can prove to the market that they can handle their debt situation and if they can hit those free cash flow targets, which are consistent with what the analysts think, at least for now, I think the sentiment on the company could start to change very quickly. Yeah, it's obviously, this is what we've got to remember as well. Warner Brothers with Discovery is trading cheaper than anywhere that Discovery traded by itself as a sole company, which is really strange, right? Discovery, much smaller company, you know, trading up here, what is that, in the 30s and 40s, and then down here in the 20s, but never down at $11 a share. All of a sudden it's trading down there. The only reason why that would be because of the debt, but I think looking at the free cash flow growth, you're getting a market cap of the company of, you know, 100 billion, 50 billion of debt that they've got to pay down, leaves about 50 billion of equity value, which is a significant upside on the share price. I think that this could be a double if the market lets it reach fair value. However, I do think it could take a lot of time for the market to do that. Therefore, I think it is something you want a dollar cost average into. I think the time frame could be multiple years before the market recognizes value. We'll see how we are, you know, when we get to the 2022 full year results. It'd be interesting to see how that plays out and whether Warner Brothers Discovery can hit their growth targets. I hope you guys enjoyed this video and found it useful. I appreciate that was a lot of information, but I hope that it has cleared up any questions you might have had on Warner Brothers Discovery. But any more comments, please put them below the video and I will get back to you guys. I wish you all the best with your investing and I will see you guys again in the next video.